Hello, and welcome to our second quarter 2018 strategy review. We held our review in this room, as usual, right at the end of March, just before the end of the first quarter. Joining me was Len Skena, on my right, CEO and Vice President of the firm. On my left, Bob Toomey, Vice President and Director of Research. Also, Nat Bowie, our paraplanner, was with us and really contributed quite a bit, looking at kind of the younger generation, as she is definitely much younger, for those of you who haven't met her. And Andy Luckel, who has joined us before, who is an independent investment advisor, joined us on the phone. So we had a very good group, and frankly, we had some very lively and lengthy discussions. Probably the first thing we started with was volatility. Since we met last quarter, we experienced a unique type of an event. In February, we had 9 days where the market dropped over 10%. And that certainly contributes to a concern about what happens in those kind of volatile times. On the screen right now, there is a chart which kind of shows a background of what does happen or has happened. Because looking back, is this a unique event? And the answer is it's rare, but not unique. Since 1960, there have actually been 10 periods where the market has fallen that quickly. The interesting thing is that you'll notice on the chart that historically, after declines, all serious declines of over 10%, generally speaking, the markets have performed well. But the periods where it's declined this rapidly are again quite unique, and during that period, you'll notice markets have gone up on an average of 17% after these unique periods. So a reaction certainly expected by most everyone, a sharp reaction of that kind, unsettling, but when you look at it historically, it might actually be a positive. And part of our discussions revolved around that sort of situation. With that, I'd like to turn it over to Bob to talk about our outlook for the markets and our outlook for the economy.
Thanks, Dan. I'm going to open my comments to follow up those comments on volatility that stand, I think, very aptly and described extremely well, putting volatility in context. What has been causing the volatility really are a number of things. The U.S. trade policy, I'm sure you're aware from seeing in the news that there's been a lot of consternation around the Trump administration's trade policies. That has had an effect on volatility. Also, we've seen some recent indications, what I call green shoots of inflation, that I think spook the market a little bit and I think creates concern over the outlook for interest rates and Fed policy. And then thirdly, I think the optics around the continuous changes that we're seeing in the White House and the Trump administration, I think some of that I think can be as a little bit disturbing for the market and a little bit unsettling. So when we look at volatility, as Stan pointed out, volatility is normal. Markets do not go up in a straight line. And I would certainly point out that the environment that we saw in late 2016 and 17, where we had very low volatility, is an aberration. That was a historic record length of low volatility, which we don't think will be repeated. So historic intraday volatility, I want to point out, is about 1%. And that means that the market on average will move up or down about 1% over the long term. So the numbers look big because the market is so high, but you really have to put it in the context of percentage volatility. And in that context, I would like you to keep that in mind when you see these daily changes in the market. 1%, about 1% is normal. Also, we expect more normal volatility this year going forward. So in terms of the underlying market fundamentals, we continue to believe that they remain sound. Corporate profits look excellent this year. Inflation we expect will remain moderate in the 2 to 2.5% range. The U.S. and global economies continue to look very strong. And we think that there's been a little bit too much of an emotional reaction to the interest rates and inflation data. Relative return continues to favor equities, and that is why we've continued to maintain an above average weighting in that sector. So I'd like now to turn it over to Len to talk about our international strategy.
Thank you, Bob. International stocks have been outperforming domestic equities for recent past, and that's a trend we expect to continue. We have been overweighting Europe for quite some time, and at this time we're scaling back a little bit. We still like Europe, and we have a healthy representation in our portfolio through the EAFE index, which stands for Europe, Australia, and the Far East. So we're not getting out of Europe by any means, but we're just not going to overweight it again. Instead, we've chosen to take that portion of the portfolio and welcome emerging markets back into our portfolio and into our allocation. The emerging market countries at this time have been doing quite well, and we expect them to continue to do well. Their valuations right now are very, very attractive, and we felt it was a good time for us to reintroduce them into our portfolio after a period where we had felt that it was wise to get out of it for a little while. With that, I'd like to turn it back over to Stan to talk about REITs.
Thanks, Len. REITs are once again an area that continue to contribute nicely to the overall returns, dividend-type returns in the portfolios, but we had similar concerns over the large shopping center component in the large REIT portfolios represented by the Vanguard REIT, which is our main investment. In an attempt to diversify and get a little bit more exposure away from shopping centers, while we still like REITs in general, other types of real estate, we did get out of the medical REIT, which we tried last quarter, but we continue to emphasize the industrial REIT. And again, we still do not disfavor the REIT portfolio. We still continue to appreciate the pass-through dividends that come from the REIT portfolio, but we are attempting to recognize that concern with the shopping center component. And of course, we're talking about the Amazon effect that everybody's shopping online. With that, I'd like to turn it back over to Len to talk about fixed income.
Thank you, Stan. We spent a fair amount of time talking about the fixed income area in this meeting. And one of the key reasons for that is that the Fed has been raising interest rates, and we expect them to continue. In fact, we anticipate that they're probably going to raise rates 4 times this year. As they raise those rates, bond holdings typically lose value. And we have been trying to find ways to play defense during a period where rates start to go up and try to keep values from dropping for those people who are both holding fixed income as well as predominantly holding fixed income in their portfolios. One thing that we've chosen to do at this time, and a change that we have made, is that we are replacing a portion of the short-term bond holding that we have from just general short-term corporates into floating rate corporate bonds. Now, these bonds have rates that will adjust as interest rates adjust in the market. And so what will happen is, as the rates go up, we can benefit from rising yield there, but the value of these bonds will not drop as precipitously. We are giving up a little bit of yield in order to get some of that stability, but that's something that we feel is probably prudent at this time, and it's a change that we feel comfortable making. With that, I'd like to turn it over to Bob to talk about our holdings.
Thanks, Len. So what happened following our meeting, if you look at our macro allocation, we actually did slightly reduce exposure to investments, if you will, both in the equity and the fixed income area. Our allocations dropped a smidge, and that means that your cash position on a relative basis will go up very slightly. And we think that's probably a good thing in light of the fact that we do expect more volatility in the market this year. That said, we remain overweight in equities, both in the international area and in the US. Right now, we remain slightly underweight in REITs, and the reason for that has been they are somewhat interest rate sensitive. However, the REITs have been through a fairly difficult time over the last year and a half, and we think they do offer good value at this point. We increased our weighting in natural resources because we do think that there will be a slight increase in inflation, and we think natural resources are a good hedge against rising inflation, although again, we don't expect inflation to go crazy on the upside. In terms of individual sector holdings, as Len mentioned, we exited our large Europe ETF and introduced an emerging market ETF and added the floating rate notes in the short-term fixed income area. Remember that the reason why we diversify is to reduce portfolio volatility, and clearly time has shown that diversification, the way we do it, does help to improve risk-adjusted return. With that, I will turn it back to Stan for closing comments.
Thanks, Bob. I think you can see that there were some very interesting discussions, but left us still in a fairly positive mood, although certainly not ignoring the volatility issue. One thing that I think it would be interesting for everybody is to go out, as I've talked about in the past. We have our previous videos on our website. And I went back and looked at 5 years ago, second quarter 2013, and there were, well, two primary things to notice. Number one, we thought we needed to be more formal, so we were all wearing ties. But on the other hand, and more importantly, it was a very interesting video because what we pointed out was we had just gone to new all-time highs at that period of time. Bob spent quite a bit of time talking about valuation because there were concerns that maybe the markets were too high. And we've had some charts which demonstrated that going to an all-time high might actually usher in another very, very positive bull market. Well, that was 5 years ago. Looking back, I would say that was very predictive, and it did have reasonable underpinnings. So again, I always talk about, take a look at what we've been doing. You can look at all of them. And in the meantime, we'll be happy to see you again here next quarter. Thanks for tuning in.